7A or 504? Find out the difference, coming up next. What's up everyone, it's Josh from the University of Laverne Small Business Development Center. And here at the SBDC, we help small businesses start and grow with free one-on-one consulting and free resources just like this one. So getting a small business loan is an integral part that many small businesses use to start up or grow. The most common SBA loans offered for small businesses are 7A and 504. The terms of the loans may seem confusing, and small business owners may not understand which one they need or they qualify for. In this video, I'm going to break down the major differences between both loan programs and which might be right for you. So each type of SBA loan has size requirements that may impact your eligibility. Eligibility for the 7A is mainly determined by industry. For example, a retail, service, or agricultural business, sales must not exceed a range of $750,000 to $33.5 million. For 504 loans, net worth cannot exceed $15 million. And meanwhile, the average net profit after taxes over 2 consecutive years cannot exceed $5 million. The program requirements for a 7A or 504 loan are the same, where the business owner needs to occupy at least 51% of an existing building or will occupy 60% for a new construction. The only main difference is that all the assets purchased with a 7A loan must be used for the direct benefit of the business. Meanwhile, equipment purchases with 504 loans must have a minimum of a 10-year economic life. The third difference we need to cover is the purpose you would need for either a 504 or 7A. Now, generally speaking, a 7A is the most popular and a multi-purpose loan that SBA offers. It can be used for a whole host of business finance needs, from starting a business to purchasing a business or expanding your existing business. The 7A loan can be used to help with buying equipment, working capital, purchasing inventory, or leaseholder improvements. The 504 is almost completely real estate related, like purchasing land for new construction or purchasing a building. The 504 loan can be used to finance building expansion or improvements and larger equipment purchases that the 7A can't cover. Now, the next difference is the amount of money the business will get, which is significant. The 7A ranges from $50,000 up to $5 million to cover general purpose needs for most small businesses. So the 504 loans have a larger range for the loan amount, which is $125,000 up to $20 million, and range from real estate related to larger equipment purchases that I did mention earlier. So the loan structures for a 7A and 504 loan are very different. 7A loan structure is flexible and are dependent on the amount of risk, but generally has a down payment of 10% of the loan amount, but often 20 to 30%. Now with 504 loans, the structure looks very different. The loan structure is with 3 entities: the business owner, the bank, and a certified development company or CDC. The CDC is the primary lender in this process and handles the loan package and makes up 40% of the total loan amount in a first mortgage. The second mortgage is supported by the SBA through a commercial bank loan. This will make up 50% of the total loan amount. Now this means the final 10% will be the small business contribution, and in some circumstances, such as a startup under 2 years, or if there's a special property involved, may require 20% contribution. Now when it comes to the loan term length, the differences are primarily based on the use of funds for either 7A or 504. For example, a 7A loan that is used for working capital is typically in the range of 5 to 7 year terms. If you're looking to purchase equipment or acquire a business, the loan term expands up to 10 years and up to 25 years for real estate related purchases. 504 terms are much more simplified since they cover fewer types of purchases. For example, an equipment purchase is up to 10-year loan terms, while the real estate related purchases are 25 years like the 7A. So SBA programs are known for having some of the lowest rates for small business owners. 7A loans generally have higher variable rates in the range of 5.5% to 9.5% based on the situation. 504 loan terms have much lower rates due to the loan sizes and the nature of the program. These tend to be fixed for the life of the loan and hover around the prime rate of 3.7 to 3.94%. Collateral for both 7A and 504 loans are very different, with one notable similarity. They do require personal guarantees from principals with at least 20% ownership. Otherwise, the 7A must have collateral for both the loan amount, and the collateral can be in real estate equity for both residential and investment properties. 504 loans are very different, where the project assets or properties that are being financed can be used as collateral. This means that the assets can be repossessed and sold through foreclosure process if the business is unable to make the payments on the loan. So each of these loans does come with fees associated with the process, and you should be aware of how they can grow according to the type of loan you want to pursue. Now, for the most part, fees associated with the 7A and 504 can be financed within the loan. With 7A loans, there is a 0.25% surcharge on the loan over $1 million. Now, if you decide to pair the 7A with the 504, additional fees will vary depending on the size and loan amounts. With 504 loans, since there are two lenders, there are two sources of fees. With the bank loan, fees are negotiated at 50% of the loan amount. On the CDC side, there is a 2% servicing fee allowed by the SBA and a legal review fee. So the SBA and 504 loans are powerful tools to start and grow your small business. You now have the information you need to determine which loan might be right for you, and can weigh those considerations that small businesses are concerned with, like collateral, interest rates, and fees. If you need more help with applying for an SBA loan, contact your local SBDC and speak with a business consultant for free. But let us know which SBA loan you're interested in and what you would use it for. Throw them down in the comments below. If you found this video helpful, hit that like, share, and subscribe to the channel. And don't forget to enable notifications to get updates on all of our newest videos when they get published. Are you looking for more information on other ways to fund your new business? Check out our video on 5 ways to fund your next startup right here. Thanks for watching, and I'll see you in the next one.